Dr. Peter Warburton, Director of Economic Perspectives, outlined last fall the three bear threats to the global economy and financial markets. He says while two have subsided for the moment, one remains unavoidable.
I don't see any way out of this. I don't know if it's going to be ultra painful or just moderately painful. I think a lot of wealth is going to get destroyed. And I think gold is going to be seen as a very safer place to be.
SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. SD Bullion continues to gain industry market share by being one of the premier low-cost options for physical precious metal bullion buyers and sellers. At SDBullion.com, you can order your guaranteed physical precious metal bullion products online, 24 hours a day, 7 days a week. Discreet, low-cost delivery is both fast and always fully insured. We are committed to being your trusted source for low-cost, highest quality investment-grade bullion products. Visit SDBullion.com for more information.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and with us today is Dr. Peter Warburton from Economic Perspectives. He's the director. Dr. Warburton, thank you so much for joining us today.
Pleasure.
All right. Now, the first topic I'd like to discuss is about your recent article you wrote. Now, you talked about really three bearish scenarios for the economy. You said that one was inconvenient, one was somewhat avoidable, and one was unavoidable. And these are all threats to the global economy. I guess starting with the first one, you talk about nominal economic growth and how if it remains strong, and gets stronger, this could actually have an impact on interest rates. Interest rates would spike, and ironically, it would actually lead to a halting of the economic recovery. Did I understand you right? And can you expand on that a bit?
Sure. Yeah, I mean, this was, just to put this in perspective, we were talking about this around last September, October time. So it was before if you like, the plunge in sort of optimism about the economy. So if you remember back in September, we were still getting some quite strong inflation data, certainly wage inflation data coming through. I mean, in a sense, that hasn't changed a lot, but clearly we hit up, I think, 3.25% roughly on the 10-year Treasury bond around September time. But rather than pushing on from that, obviously we pushed back, we pushed away from it, and we've since seen really quite a dramatic, what people call a Powell pivot. He's kind of pivoted away from that more aggressive path of tightening. But the principle remains the same. We look back for a number of countries back over the last 50 years. And what we discovered was that the causality, insofar as one can determine it, runs from the nominal growth of the economy, that's the money value growth of the economy, to bond yields, rather than the reverse. So in other words, it's the nominal framework of the economy that kind of sets the music for the bond market. At least that's how it's been. And basically this happens fairly quickly. It happens within a year that you get a peak of nominal growth and a peak of bond yields. But beyond that, really, there isn't a lot of difference typically in the nominal levels reached. So if you have a 6% nominal economy, you should definitely expect to get a 4% nominal interest rate environment out of that. Now, obviously, we're not living in normal times, and certainly the financial crisis, in my mind, isn't fully resolved from 10 years ago. But nevertheless, I think it was reasonable. We had a view last year that interest rates could get to 3.75%. Obviously, that didn't happen, and we pulled back, and we're now sitting in the 265, 270 sort of region on the 10-year. But the point really is that we could have pushed on from that 325. We could have pushed on, to 350, and bond positions were year to date underwater. And sometimes what happens is you get towards the end of the year, investment funds don't want to be seen to be holding the wrong asset at the end of the year when they have to kind of give more disclosure. And so it was, for me at that time, back in September, it was perfectly credible that we could move into a bond yield spike scenario. But we didn't. Events took a different turn. As I say, I think we could still revisit that scenario. But the inconvenient scenario, if you like, has receded. So that was our number one. And just to give a little bit of gloss on why could it spike? Well, the answer why it could spike is because the amount of money which is invested either in short volatility or explicitly in some kind of risk parity framework. I don't know how sort of aware people are of risk parity, but the essence of risk parity is that you're balancing what you perceive to be the riskiness of different elements of your portfolio rather than a more conventional 60% equity, 40% fixed income mix. So the idea is that you on a volatility or a risk basis, you should be able to have a much bigger element of bonds, even to the point of levering your bond portfolio in order to have an equal amount of risk in your bonds to your equities. So what I was fearful of was that style of investment where they levered the bond positions, they could be then deleveraging very rapidly, and that could give you a kind of an exit dynamic that would give you a spike.
And do you still see that as a possibility? You said that was kind of avoided just recently, but do you still see that as a possibility?
We could go back to that, but clearly I think to go back to that now, we'd have to see a lot more nominal pressure and certainly a lot more inflation pressure than we see right now. So I think it's not an immediate threat.
Great. Well, in that case, yeah, definitely. That's a good thing. And you also talked about the avoidable threat, and we'll get to the unavoidable one, but the avoidable threat was essentially that the central banks are kind of acting a little hawkish right now, where they're either stopping bond purchases or tapering, or in the case of the U.S. Fed, liquidating bonds. How is this going to impact the economy?
Yeah, I mean, it's a very good question and not an easy one to answer. But let's put it this way. There are, if you like, academic notions of how much excess reserves of banks there needs to be in the system. Okay, so you can do some calculations and you can wind up with saying, well, okay, the system ought to function perfectly well with $750 billion of reserves, of excess reserves, let's say. But the reality can be very different. The reality is you've got some very different organizations, even looking at the mega banks in the US. And they run their balance sheets and their derivative portfolios really quite differently from each other. So to be able to say that such and such is the critical level of liquidity in the system, given all the bank regulation, the Dodd-Frank and Basel III and so on, is I think that's pretty cavalier, because you almost need to look at this kind of piece by piece, firm by firm, as to what a binding level of liquidity is in the system. So what I'm saying is that what we've explored in the last 6 months is the notion that the binding constraint, the point at which you start to lose critical liquidity in markets and make yourself vulnerable to gapping, price gapping, and potential counterparty problems, that binding point seems to be much closer at hand than the Fed imagined by taking an academic approach to what would be required. So what we've seen is actually quite a significant backtracking by the Federal Reserve in terms of the total scope of its balance sheet reduction and the pace. So it's moved into a kind of holding pattern. The next thing I think will be an announcement that they will either reduce the pace of shrinkage of the balance sheet and or they will set a terminal level which is closer to $3.5 trillion rather than the $2.5 to $3 trillion. So why is it the avoidable threat? It's avoidable because they can decide not to do it. They can decide not to shrink the balance sheet. They could decide to say, well, actually, $4 trillion sounds pretty good to us. You know, we'll halt it there, so that they could put this program on pause tomorrow. Obviously, they have a credibility issue. So it was Janet Yellen who set the program in motion in June 17. And what Powell and his Fed would have liked to do was, just to let the thing run at its pace and make all the adjustments on the rates, the federal funds target rate. But I think the fourth quarter of last year, particularly December last year, has proved to them is they need to be more pragmatic. They need to be more responsive to the way that the market conditions are evolving. And so they have, under pressure, listened. I think what really got their attention was when credit spreads started to blow out at the end of last year. And so since then, obviously we've seen a much more pliant, accommodative Federal Reserve. And the avoidable threat for now looks to be going off the table. Obviously, we've had a risk rally. We've seen equity prices regain roughly their kind of November levels. And we've seen credit spreads in the main settle back down again. We've seen the VIX and some of the volatility measures settle back down, to quite low levels again. So, we've proved that it's avoidable.
Definitely. But there is one threat that you talk about in your article that is really unavoidable. And it's kind of the rising interest rates. And you say that it will cause a need to refinance corporate debt. Can you discuss the impact this will have and why this is unavoidable?
Yeah, I've called it the unavoidable threat because we're already far enough into a tightening cycle that, we could imagine that the Fed stays on pause and then maybe sometime in 2020 maybe starts to think about reversing the rise in rates. Or we could even think that, we get inflationary pressures starting to reassert later in the year, and the Fed thinks it's appropriate to add back some rate increases still, which is it's kind of left it in the dot plots, if you like, as a possibility still. So basically, this tightening cycle has already gone far enough that it is butting into a major refinancing cycle. And it's a refinancing cycle for government debt, for investment-grade corporate debt, and for high-yield corporate debt. And there's a lot of it. We're talking over the next 3 or 4 years, easily $2 trillion of corporate debt and a ton of government debt as well, which basically there's a lot of treasury bills that are rolling, a lot of shorter dated debt, which sensibly the US Treasury ought to be replacing with longer duration. So the point that I'm making is we're already too far down the track for this not to become a problem. So for the last 10 years, it's been possible, to kick the can down the road, basically to, even if you were in poor shape with your balance sheet and your debt, typically you'll be able to refinance your debt. You'll be able to live another day, And and obviously there's this term zombies. There's like zombie corporations. There's maybe even zombie sovereigns, but there's certainly zombie households, where basically they're on a kind of life support system, in a kind of a nearly dead state. But they're kept alive in some sense by very, very low interest rates and very low expectations of debt service and repayment. But what we're saying is we've left that world behind. So, for example, if you look at the consumer delinquency cycle, that ship has already left port. Basically, we're already about a year into rising delinquency default rates for consumer debt. We're still well below the 30-year average of delinquency, but we're off the bottom. We're traveling. We're traveling into a new debt default cycle for consumer debt. Corporate debt is pretty much, is behind that. It's kind of maybe just around now, maybe in a few months, we'll start to get a new corporate debt default cycle on the move, and it will keep moving. Now, the problem here is that we've had this phenomenon called reach for yield, and it's been an international phenomenon. Which country has been the biggest beneficiary, recipient of international reach for yield? Why? It's America. Basically, literally trillions of dollars have come from retail investment funds, pension funds, insurance funds, hedge funds, picking up what has seemed an easy yield pickup. And obviously it's led to the manufacture of more corporate debt. We've had corporate debt indices that have been so oversubscribed. They say, just, go out and find us some more of this stuff, and so, if you like, that dynamic has been playing out for years. And people who've invested in corporate bond funds, typically, they've been coming out with, 7, 8, maybe 10% annual returns. It's been the resting place for a lot of retail money. They've abandoned equities after the global financial crisis, in 50% write-downs or more in their equity positions. They've not wanted to stay in the safety, supposedly, of government bonds. So corporate bonds have been a happy middle, a happy medium. But it's now at the stage where that's a very dangerous place to be, because things can happen quite quickly. You don't have to wait for the downgrades. Basically, we saw with GE debt that concern over a particular part of their business, I think it was care homes, can all of a sudden, the debt price can fall by 10%. So it's like it's trading as junk, but it's still rated as investment grade, but it's trading as junk, and ultimately the rating, may very well catch up, and make a huge bundle of debt uninvestable by funds that can only invest in investment grade debt. So basically, there's some very dangerous things happening, and I'm saying it's because the opportunity to refinance at existing rates has gone, and increasingly, for some it'll be the opportunity to invest at a higher rate, which some can manage if they've got the cash flows, and some won't. But for others, it may be that the whole refinancing option is evaporating. The window for refinancing is evaporating, and good luck to them if they think they can replace it with bank borrowing. I doubt they'll find it easy to do that, or otherwise it's sale of the business, fire sale of the business, in order to exit the debt position. So what I don't see any way out of this. I don't know if it's going to be ultra painful or just moderately painful. I think a lot of wealth is going to get destroyed, and I think gold is going to be seen as a very obviously safer place to be once the avoidable threat really starts to to take hold.
Definitely. And what is your perspective on how gold will be impacted by this situation? Because we've seen over the past 5 years, if we just look at the gold chart, it's been pretty flat. What is your perspective then? Do you think it'll kind of break out of its, kind of sideways trend and start moving higher?
Yeah, I mean the work we've done, is I'm sure replicated in many places. I mean, these are very well established. So basically, since about 2002, gold has had a significant negative correlation with three things. This is the dollar gold price has been negatively correlated to the dollar. It's been negatively correlated to real interest rates, and it's been negatively correlated to the stock market, the S&P 500. So basically, it's actually been doing remarkably well. To say that the S&P hasn't, as maybe arguably has entered a bear market, but obviously it's not out of the question that it could have one final, blow-off rally. But gold's done pretty well to say that the stock market is still relatively close to highs. Real interest rates haven't really done their stuff. So the US real interest rate is around 1%, or a real yield on tips is still kind of I think probably sub 1%. So they've had a bit of competition from real interest rates, but it's not been great. And obviously the dollar, the dollar slumped in 2017 and then rallied in 2018. So 2018 has been a tough year from a currency perspective. So what I'm looking towards here is the dollar being in a bear rally. It's a bit 2018 being a bear rally, and so the dominant underlying trend of the dollar being negative. I'm thinking particularly the DXY which is heavily weighted to the euro. I'm thinking that maybe real interest rates, maybe they push on a little bit, but not very much. And I'm thinking that yes, that we are likely to come to a point where the S&P establishes its a bear market, with a downside of 30 to 40% from its highs. So I'm saying that the circumstances where I would expect gold to perform are not far from coming to fruition. And that will be breaking out of whatever range you see, 1350, 1400. So breaking through that and above that. The other thing to say, which is I'm sure that you'll have strong views about, but when the UK was one of the first countries to introduce inflation-protected bonds, so I know that it was many years later that the US started issuing TIPS, inflation-protected securities. But certainly the central bank line about when it started issuing index-linked gilts was, well, it's the death of gold, basically, because now you have something which is as good as gold in terms of capital preservation, but it has a yield. Obviously, this is when UK index-linked gilts had a positive yield. They've latterly moved to a negative yield, which is a bit different. But the reality is that gold is performing better than TIPS. And whether it has something to do with economic uncertainty, whether geopolitical uncertainty, whether it has something to do with financial volatility, but whatever it is, it seems that gold is performing better than it has any right to do. And I think the hope would then be that it would perform better still if the stock market was less of a challenge, and also if the currency again returned to a negative trend.
Definitely. And now you've talked also about, in your article, about gold equities. What is your perspective on how they will react to this rise in the gold price?
Well, surely it can't do them any harm. I think that there's we need a catalyst, basically. But one of the big trends which has accompanied the equity market rally out of 2009 is this transition from active fund management to passive fund management, and sort of whether it's mutual funds, ETFs, tracking, various sort of tracking devices. It's been very bad for gold, I think, because essentially what helped the gold equity sector was a lot of active investors, looking for these junior stocks, and looking to find situations where there could be a lot of capital appreciation, a lot of corporate event-driven capital appreciation. But I mean, in a capital market dominated by passive investing, there's no capital to put behind these small stocks, and I think one of the problems for the major, the largest, the Barracks and Gold Corps and Newmont and so on, is they now don't have the pipeline of smaller companies, to bid for and buy up. So I feel what we need, and probably will come again, is when we move more obviously into a bear market for stocks. I think it will also revive, active management. I mean, obviously, it's asking a great deal, to bring back, for people to prefer active managers with fees over passive managers with, negligible fees. But I think it's only as you get at least some rebalancing from passive to active that you bring the gold equities back into the game.
All right. Well, Dr. Warburton, thank you so much for your time today. I guess before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Sure. Well, just to give a bit of background, so I've been doing macroeconomics in London since 1975, so a little while. I wrote a book called Debt and Delusion in 1999, so that's now 20 years ago. But basically, so my calling card really here is that I think that debt and credit are absolutely fundamental to an understanding of our global economy and financial markets. So for the last 23 years, we've had our company, Economic Perspectives. Basically, we've had a very eclectic view of the world. So we like to feel that we're quite observational. We're not too dogmatic about economic theory and drivers and so on. So basically, we run a subscription service. So if you go to our website, economicperspectives.co.uk, then you'll see something of what we do. But it's mainly a service for bigger investors and funds. But there's some material on our website, hopefully, which will be interesting to the people who subscribe to your to Silver Doctors and so on. But sure, we're mainly institutional. Very very happy to be invited onto your show. So thank you
Once again, thank you so much, Peter.
Yeah. Take care.